So a recap coming up. I'll be going quickly through some ratios. If you want to find out more about them, then I'll give you a source at the end. So background would be what? There are many ratios, numbers, that claim to reveal cheap and expensive stocks. Not all of them are relevant to all stocks and all sectors is my point, so let's get the right tool for the job in hand. A recap on where we're going then. Most investors want to know whether a share represents good value or not against its peer group, against the wider market, against alternative places to put their money. That means comparing price to something. Price is what you've got to pay to buy a company. So we're going to look at the share price or the market capitalization. If you want to do it on a sort of macro basis, we're going to compare it to something to get a handle on whether it's cheap or expensive. In other words, the principle here is how many times that something else is the current price. The higher the multiple, the more expensive the share and vice versa. So what is the something else? Well, let's start with the one that's published everywhere and therefore tends to get the most publicity, the price to earnings ratio. So what is this again? Fast recap coming up, more information available at the end. This compares the latest share price to 1 year's earnings per share, or the market capitalization of the business as a whole to an entire 1 year's earnings typically. Now that earnings figure can be historic or consensus forecast, tends to be more commonly used because investors are looking forward. So if we had, let's say, a share price of 100 pence, very simple example coming up, and the consensus forward earnings per share figure was 10p, that would give you a PE ratio of 10 times. All right, the higher that number, the greater the expectations on the company looking forward. The lower the number, the relatively cheaper the company is compared to what? Peers, the wider market, and so on. So low is cheap and high is expensive. But here's the point. Is the PE ratio the only number out there? No. Earnings may be small, non-existent or negative, in which case the E isn't reliable and neither's the PE ratio itself. As such, you may not have the key growth driver in your sights. Is it earnings that's actually the main reason why investors are interested in the stock? That's what growth drivers are. What else could you use as a value benchmark? So what else could you compare the P or the market capitalization to get a view on whether it's cheap or expensive? And there's an important expression in there. What is driving investors to be interested in the stock? What is it they want from the stock? It isn't always earnings growth. Indeed, it may not be earnings growth that's actually what you're getting for some time. So, price to sales. In other words, if you've got a company that's losing money, all right, and or moving out of profit into loss, PE ratios don't tell you much, so there's price to sales instead, the PSR. So this one is useful for fast-growing firms that may have no earnings. You're doing price per share to sales per share. I won't do another calculation, but let's say sales per share was 10p, price per share 100p. This time the price to sales ratio would be 10. So you can use it as a benchmark. Sales are a key number. Without sales, do you have a business is the key point, and are seen as relatively pure. In other words, the sales figure doesn't have lots of subjective costs knocked off it, like profits. So PSR has its fans, but it's dangerous in isolation because at what point do you want to see earnings? Do you want to see cash flow? As Sir Alan Sugar once put it on The Apprentice, you can take a £10 note and sell it for £9 every day of the week. You'll have tremendous sales, but you'll go bust very quickly. That's not a business. So at some point, the PSR needs to make way, I would suggest, for other ratios. But in the early stages of a company, or a company where you can't get a reliable earnings and cash flow number, maybe it's the right benchmark. And especially where the company's main task is land grab and growing. What about price to book? So maybe we're not going to use PE, maybe we're not going to use PSR, maybe we're going to use price to book. So what would that be? Well, some firms are rated by their ability to grow a book of assets. Well, what sort of firm would that be exactly? More than they're tasked sometimes with growing earnings stroke sales, if you like. So examples would include banks, in a lot of cases, property investment companies, their job is to grow net asset value, if you like, and investment trust companies. Hence the reason people obsess about is the share price above or below net asset value per share. But the great key question then is, do you trust the book? Can you use price to book in sectors where there is no book? Arguably not. Tech companies it's pretty hopeless in, for example. And do you trust the book? Because the book is the balance sheet value of the company put together by accountants. It includes lots of squidgy things like goodwill, intangibles, and it may be unrepresentative anyway of what the business is actually doing day to day. So maybe we go for price to cash flow. Now this assumes you've got some positive cash flow in the first place. Lots of analysts, the traditional sort, like cash. They argue that sales are vanity, profit is sanity, and cash is king. So in other words, sales, can't trust that. Profit, not so sure. Cash is the real demonstrator of whether the business is doing the right things. As an investor, your main focus may be the return of your cash. This is important where people are thinking, actually, at the end of the day, am I going to get my money back? When am I going to start making some? If you're after dividends, cash flow is vital, of course, but does a focus on cash flow per share and price to cash flow or free cash flow limit your portfolio breadth? Are you restricting the shares you buy to a small pool? Now, some investors will say yes, and that's quite deliberate, and that's the safety margin I want. But for other investors, that will take out certain sectors that might offer longer term growth by other metrics. Then you've got price to earnings growth, worth a mention. You'll hear Jim Slater talk about this a lot, the PEG ratio. So here we've got a variant of the PE ratio that swaps earnings growth, typically average, and you've got to look at the right period, 2 years, 5 years, for example. Basically, it's Jim Slater's favourite yardstick, especially where on the comparison of price to an earnings growth rate, he can find something less than 1. The problem is finding firms with a PEG ratio of less than 1 is challenging in the current market, and it's only as good as a number as those growth estimates and forecasts. And it assumes that earnings growth is a key driver of the business. Finally, and we'll wrap up with this one, price to ebitda. This sounds like the most glamorous, earnings before interest, tax, depreciation and amortization. More detail in other videos. This is a number that's somewhere between profit and cash flow. So it's like an adjusted profit figure, if you like. Now, it is popular in certain sectors. It's effectively adjusted profit and a proxy for cash flow. It strips out the effect of capex and financing decisions, hence the profit before interest, depreciation and amortization. But does it flatter the directors? If you're looking at a fast-growing company where the directors have said we want to be benchmarked on ebitda, are you looking at a number that over-flatters what they do and doesn't consider the cost of the growth they're achieving? To find out more about any of those and where they're most sensibly used, there's the usual email address. And to watch videos that take these into more depth on individual ratios, it's gillick.com/learn and the financial ratios tab here.